Disclaimer.
The trap just snapped shut. While the media predicted $50, silver just smashed $82, leaving bullion banks dead in the water. Remember their massive short bets at $40? They are now officially trapped in a nightmare of their own making. The paper market is breaking, and the Monday reset is here. Today, as I'm showing you the leaked data on which banks are facing liquidation and why $82 is just the beginning. Because what we're watching unfold isn't just a bad trade that went wrong. This is a systemic miscalculation that could fracture the entire commodity pricing system. Imagine betting your entire career that something worth $121 will crash to $40, only to watch it stabilize at $82 while you're contractually obligated to deliver it at the price you promised. Now imagine you don't actually have the thing you promised to deliver, and the real cost to buy it is not $82. It's somewhere between $100 and $130. This isn't hypothetical. This is exactly where major banks in America and London find themselves right now with silver, and March 2026 is when the bill comes due. TD Securities made headlines throughout 2025 with a bold prediction that grabbed attention across financial media. Their analysts published research notes confidently forecasting that silver prices would retreat toward $40 as we moved through 2025 and into 2026. When you're a major bullion bank and you publish a price target, you're not just making a prediction, you're positioning your trading desk building massive short positions that obligate you to deliver silver at specific prices to buyers who expect physical metal. TD Securities wasn't alone. According to regulatory filings, major institutions, including HSBC, Deutsche Bank, and Goldman Sachs, built substantial short positions throughout 2024 and early 2025, with entry points ranging from $50 to $60 per ounce. The logic seemed sound. Silver had rallied hard, industrial demand looked soft, and the Federal Reserve maintained hawkish rhetoric about elevated interest rates. Precious metals historically struggle when interest rates climb because holding silver pays no yield while bonds suddenly offer attractive returns. But here's where Wall Street's comfortable narrative collides with reality in spectacular fashion. On January 29, 2026, silver didn't retreat toward $40. Silver exploded to $121 per ounce in a single trading session. Then on January 31st, just 2 days later, the market crashed 36% to $78 in the worst single-day drop since 1980. That violent swing gave banks about 12 hours of relief. Except the crash didn't stick. Silver is now breaking back above $82, and those bank short positions have transformed into financial nightmares. Let me give you the math that should make anyone managing a trading desk lose sleep. If you shorted silver at $55, expecting it to fall to $40, you plan to profit $15 per ounce. Instead, at $82, you're losing $27 per ounce. Every silver futures contract represents 5,000 ounces, which means every contract written at $55 is currently underwater by $135,000. Scale that across the estimated positions these banks hold, and you're looking at billions in unrealized losses that grow larger with each dollar silver climbs. The CFTC Bank Participation Report from December 2nd, 2025 provides official confirmation of just how exposed the banking sector became. Commercial banks reported net short positions totaling 212 million ounces of silver. At $82 versus their $40 target, these institutions face losses of $42 per ounce across those 212 million ounces, approximately $8.9 billion in current underwater losses. JP Morgan alone likely holds short exposure between 50 and 100 million ounces, representing potential losses ranging from $2.1 to $4.2 billion at current prices. Now you might be thinking, banks made a bad bet, they'll take their losses and move on. Except there's a problem that transforms this from a bad trade into an existential crisis. These banks don't just owe money, they owe metal, physical silver. And increasingly, the evidence suggests that metal doesn't exist at these prices, or possibly doesn't exist at all in the quantities promised. Have you noticed something strange when you try to buy physical silver right now? Check any precious metals dealer, and you'll see premiums of 5 to 15% just to get coins or bars delivered to your doorstep. But what's happening in professional wholesale markets overseas should grab your attention, because the numbers don't just seem high, they seem impossible. The Shanghai Futures Exchange, where industrial buyers in China price their silver transactions, has been trading at prices dramatically above what Comex shows in New York. According to Shanghai Gold Exchange data, physical silver in Shanghai during early February 2026 traded at premiums of $22.98 per ounce over Comex prices, a 29% markup. When you include China's 13% value-added tax, the effective premium expands to 45.8%, meaning Chinese buyers paid roughly $36 more per ounce than the official Comex price suggested silver was worth. Here's why this matters. In normal commodity markets, price differences between major exchanges rarely persist for more than minutes. If silver costs $71 in New York and sells for $80 in Shanghai, traders should immediately buy on Comex, shipped to China, and pocket $9 profit per ounce. That arbitrage pressure would close the gap almost instantly. Except the Shanghai premium has persisted for weeks. The spread hasn't closed. The arbitrage opportunity just sits there, offering $30 to $40 per ounce in guaranteed profit. Yet the gap remains. There's only one explanation. There is no metal available to execute the arbitrage. You can't ship silver from west to east if you don't have silver to ship. And you definitely can't ship it after China restricted all silver exports on November 3rd, 2025. China's export restrictions created a one-way valve. Metal can enter China, but cannot leave. Every ounce that flows into China essentially disappears from Western market access permanently. Dubai markets showed premiums of 18% over Comex. Mumbai dealers reported 25% markups. Japanese buyers allegedly paid $130 per ounce. This is a global physical market in complete rebellion against the paper price being reported on Comex. Think about what this means for banks sitting on massive short positions at $82. When a customer demands physical delivery on their futures contract, the bank must provide actual metal. If the official Comex price shows $82, but actual physical silver costs $100 to $130 to source, the bank faces an instant $40 to $50 loss per ounce just to fulfill their contractual obligation. Now let's look at the Comex inventory situation, because this is where the math becomes absolutely impossible. Comex warehouses hold eligible inventory and registered inventory. Only registered inventory matters for delivery. It's silver, specifically designated as available against futures contracts. According to CME Group data, Comex registered silver inventory stood at approximately 103 to 113 million ounces entering February 2026. January 2026 wasn't even a major delivery month. Those are March, May, July, September, and December. January is considered minor, where deliveries typically run 5 to 10 million ounces, except January 2026 saw delivery demands between 33 and 49 million ounces, 7 to 10 times the historical average. JP Morgan provided 99% of the metal delivered, clearing 8.1 million ounces on January 7th alone. That's roughly 250 tons of physical silver transferred in one business day. Where did JP Morgan source that metal? Critical question, because every ounce delivered in January is one less ounce available for March. Current open interest in the March 2026 contract stands at over 100,000 contracts representing 500 to 528 million ounces. If just 15% demand delivery, a conservative estimate given January's unprecedented activity, that represents 75 to 90 million ounces requested against registered inventory of 110 million ounces, with 40 million already drained in January. The coverage ratio currently sits at 5.56x, meaning every physical ounce in Comex warehouses is theoretically claimed 5.6 times over by paper contracts. Banks bet $40. They built shorts at $50 to $60. Silver hit $121, crashed to 78 for 12 hours, and now trades at $82 and rising. They are trapped 105% above their target, with billions in unrealized losses and March delivery obligations approaching fast. They cannot cover shorts without spiking prices higher, cannot deliver metal they don't have, and cannot afford to buy what they need at prices 50 to 70% above Comex. The question isn't whether banks made a bad bet. The question is whether our entire paper-silver market can survive what's coming when those March contracts hit first position day on February 28th and delivery demands start flooding in. Because at $82, trapped banks are discovering this is not about money anymore. It's about metal they promised to deliver but never actually had. So how did we get here? How did silver spike from stable trading around $30 in early 2024 to $121 in January 2026, then crash 36% in a single day, only to recover right back above $82? If you believe the mainstream financial media narrative, it was just market volatility, normal price discovery, maybe some algorithmic trading gone haywire. But when you examine the mechanics of what happened on January 31st, 2026, the evidence points to something far more deliberate. A coordinated intervention that temporarily saved banks from complete annihilation, but failed to solve their fundamental problem. January 31st started like any other trading day, in what had been an absolutely explosive month for precious metals. Silver opened Asian trading around $115, still riding the momentum from the $121 peak hit on January 29th. Then, at precisely 8:47 a.m. Eastern Time, news broke that President Trump had nominated Kevin Warsh as the new Federal Reserve Chairman to replace Jerome Powell. Within minutes, Financial media outlets ran with the narrative that Warsh represented a more hawkish, inflation-fighting approach to monetary policy, the kind of leadership that would maintain higher interest rates for longer and potentially strengthen the dollar against commodities. Pop quiz. Does the nomination of a Fed chair, a position that requires Senate confirmation and wouldn't even take effect for months, justify a 36% collapse in a commodity that just hit generational highs on supply shortage concerns? The narrative made headlines, but the mechanics of the crash tell a very different story about what really happened that day. Within hours of the Warsh announcement, the CME Group, the parent company that operates Comex, announced an emergency margin requirement increase for silver futures contracts. They raised initial margin requirements to 18%, one of the highest levels in recent memory for precious metals. Now here's what you need to understand about how margin works in futures markets. When you buy a futures contract, you don't pay the full value up front. You post margin, essentially a security deposit. Higher margin requirements mean traders need to commit more capital to hold the same position. For traders who were long silver expecting continued price appreciation, this margin increase meant they suddenly needed to deposit significantly more money into their accounts or face forced liquidation of their positions. Imagine you're holding silver contracts expecting prices to keep climbing, and suddenly your broker calls demanding you deposit tens of thousands more dollars by the end of the day, or they'll close your positions automatically. That's exactly what happened to thousands of traders simultaneously, creating a cascade of forced selling that had nothing to do with fundamentals and everything to do with exchange mechanics. But here's the truly fascinating part that should make any experienced trader raise an eyebrow. While this margin increase created a liquidation crisis for long traders, it simultaneously created what market analysts have called a reverse margin trap for the banks holding massive short positions. Think about it from their perspective. If you're a bank short silver at $55 and the price is now at $115, you're facing catastrophic margin calls yourself. Every dollar silver rises means you owe more money to your clearinghouse. The 18% margin requirement means these banks faced absolutely crushing carrying costs to maintain their short positions. According to analysis from metals trading desks who were watching order flow that day, JP Morgan appeared to close approximately $10 billion worth of short positions at the exact market bottom of $78.29 per ounce. Let that sink in for a moment. The largest silver trader on Comex, the bank that delivered 99% of January's physical metal, somehow managed to exit billions in short exposure at the precise lowest price of the entire crash. All 633 February delivery notices were settled at this exact price, $78.29, despite silver trading across a $43 range that day. What are the odds that represents coincidence rather than coordination? Professional traders who watched this unfold in real time described it as one of the most precisely executed large-scale exits they'd ever witnessed. JP Morgan needed a crash to close their shorts without driving prices higher, and January 31st gave them exactly that opportunity. Then Reuters published a report mid-morning claiming the U.S. Department of Energy had abandoned support for critical minerals initiatives, suggesting that government backing for silver as a strategic resource was ending. The report triggered algorithmic trading systems programmed to sell commodities on negative government policy news, adding more selling pressure to an already collapsing market. Except, here's the problem. The report was completely false. The Department of Energy issued a formal statement hours later calling the Reuters story false and deliberately misleading, stating that no such policy change had occurred or was under consideration. By the time the correction came out, silver had already crashed from $115 to $78. Billions in long positions had been liquidated, and JP Morgan had closed their shorts at the bottom. The crash saved major banks from what would have been $17 billion in total losses if silver had stayed at $121. But it only bought them time. It didn't solve their fundamental problem, which is that the physical metal they've promised to deliver doesn't exist at these prices. Want proof? Let's look at what happened in Shanghai immediately after the crash, because the Chinese physical market's reaction tells you everything you need to know about whether that $78 Comex price represented real market clearing value or just paper manipulation. Before the January crash, during December 2025, the Shanghai premium over Comex silver ranged between $6 and $8 per ounce. Elevated but within normal ranges you'd expect when Chinese industrial buyers compete for supply. That $6 to $8 premium reflected transportation costs, import duties, and modest supply tightness. Nothing alarming from a market structure perspective. Then, January 31st happened. Comex crashed to $78, and Shanghai's physical market didn't follow. On February 2nd, just 2 days after the Comex crash, the Shanghai Futures Exchange showed physical silver trading at a premium of $22.98 over Comex spot prices, a 29% markup. Chinese buyers looked at $78 Comex silver and essentially said, that price is fiction. will pay $101 for actual metal. When you include China's 13% value-added tax that buyers must pay on silver imports, the effective premium expanded to $36.22, representing a 45.8% total markup over the official Comex price. This wasn't a brief spike that corrected within hours. This premium persisted for weeks. The Shanghai Futures Exchange showed silver trading around $80, while Comex showed $71, an $8 to $9 persistent spread that should have attracted every arbitrage trader on the planet. Here's what normally happens when such spreads appear. Arbitrage desks at major banks see the opportunity, buy silver on Comex at $71, arrange transport to Shanghai, and sell at $80, pocketing the $9 spread minus shipping and insurance costs. This arbitrage buying on Comex pushes New York prices up, while selling in Shanghai pushes those prices down, and the gap closes within minutes or hours as capital flows exploit the opportunity. Except the gap didn't close. Days passed, then weeks, and Shanghai continued trading $8 to $9 above Comex. Dubai markets showed 18% premiums. Mumbai precious metals dealers reported 25% markups. Japanese industrial buyers allegedly paid $130 per ounce, according to supply chain reports from electronics manufacturers. The global physical market was screaming that Comex prices didn't reflect reality. Why couldn't arbitrage close this gap? Because China's November 3rd, 2025 export restrictions created a one-way valve. Silver can enter China for industrial use, but cannot be exported back out. Any ounce that flows to Shanghai to capture that premium disappears from Western market supply permanently. You can't arbitrage your way back. You can't reverse the trade when spreads shift. And you definitely can't rely on Chinese silver returning to Comex warehouses when delivery demands spike in March. This is the smoking gun that proves physical shortage. When arbitrage opportunities persist for weeks instead of minutes, when premiums expand to 45% instead of 2 or 3%, when every major physical market in Asia trades at massive premiums to the official Western paper price, you're watching a market that's broken. The paper price on Comex has detached from physical reality, and banks shorting paper silver are discovering they cannot deliver physical metal at the prices their contracts specify. Now, let me show you another piece of evidence that confirms banks are absolutely desperate for physical metal: the London silver lease rate explosion. If you're not familiar with how lease rates work in precious metals markets, here's what you need to know. When a bank needs physical silver, but doesn't want to buy it outright, they can lease it from someone who holds it in vault. They pay an annual interest rate for the privilege of borrowing that metal, use it to fulfill deliveries or cover positions, and theoretically return the metal later. Normal silver lease rates in London, according to London Bullion Market Association data, typically run between 0.25 and 0.5% annually. It's a very low cost to borrow silver because historically there's been plenty available and relatively little demand to lease it. But October 9th, 2025, something extraordinary happened that should have made headlines across financial media, but barely got mentioned outside precious metals trading desks. London silver lease rates spiked to 34.9% annually, with intraday peaks hitting 39.2%. Let me give you context for how insane that is. Banks were willing to pay almost 40% annual interest to borrow silver. That's roughly 200 times the normal rate. Imagine if mortgage rates suddenly went from 3% to 600%. That's the equivalent magnitude of what happened in the London silver lease market. Why would banks pay such outrageous rates unless they were facing absolute desperation to source physical metal? The spike lasted several days before moderating, but lease rates never returned to normal. December 2025, rates were still elevated at 8%. February 2026, rates are holding at 6 to 8%, still 12 to 16 times normal levels. Banks are paying 8% annually to borrow a commodity that historically costs 0.5% to lease, and they're doing it month after month. Here's what makes this even more damning. The London Bullion Market Association reported in October 2025 that approved vaults in London held 844 million ounces of silver. That is an enormous quantity, roughly 16,000 tons of physical metal sitting in the heart of the global financial system. Yet during the lease rate crisis, when banks desperately needed to borrow just 1,000 tons to cover deliveries, rates spiked to 40%. Why couldn't they access that 844 million ounces sitting right there in London? Because 80% of LBMA silver is already registered to exchange-traded funds like SLV, PSLV, and dozens of other silver ETFs. Those ounces belong to shareholders who bought the ETF, expecting it to hold physical silver as backing. Fund managers cannot lease out that metal without violating their fiduciary duty to shareholders. So while 844 million ounces theoretically exists in London, only about 160 million ounces is actually available for lease or sale, and banks competing for that metal drove lease rates to levels that reveal absolute scarcity. Industry sources tracking Chinese banking relationships have reported that JP Morgan leased approximately 4,000 tons of silver from ICBC, one of China's largest state-owned banks, with the lease agreement requiring metal to be returned by January 2026. 4,000 tons is roughly 129 million ounces. If JP Morgan delivered 99% of Comex January demand using leased Chinese silver that's now due back to ICBC, where exactly will JP Morgan source the metal for March deliveries? This is why lease rates remain elevated at 6 to 8% even now. Banks are trapped in a cycle where they lease metal to cover 1 month's deliveries, which creates obligations to return that metal, which forces them to lease more metal for the next month, and the cost of maintaining this charade grows more expensive every week as available lease supply dwindles. Think about what all this evidence reveals when you connect the pieces. January 34th wasn't market volatility. It was a coordinated intervention using Fed chair nomination news as cover, emergency margin increases to trigger forced liquidation, and false Reuters reporting to accelerate the crash. It gave JP Morgan a 12-hour window to close $10 billion in shorts at the bottom. But Shanghai's refusal to follow Comex prices lower, the persistent global physical premiums, and the sustained lease rate elevation all prove the same thing. There is no physical silver available at these paper prices. Banks are trapped at $82, promising to deliver metal that costs $100 to $130 to actually source. And March 2026 is when the world finds out if Comex can survive its own fiction. February 28th, 2026. Mark that date on your calendar because it represents first position day for the March silver contract. The deadline when traders must declare their intentions to either deliver physical metal or demand delivery against their futures positions. As I record this, we're just 19 days away from the moment of truth, and the math surrounding March deliveries reveals an impossible situation that gets worse every single day. Silver stays above $80. Let me walk you through exactly why March matters differently than any other delivery month. The Comex Silver Futures calendar operates on a cycle where 5 months each year, March, May, July, September, and December, are designated as primary delivery months. These are when commercial hedgers, industrial users, and large institutional players traditionally roll their positions or take physical delivery. The other 7 months, including January and February, are considered minor delivery months where activity typically runs much lighter. Historical data from CME Group shows that major delivery months usually see between 10 and 20 million ounces changing hands. Significant volume, but well within Comex's capacity to handle given registered inventories that typically range from 200 to 300 million ounces in previous years. December 2025 should have been routine. Instead, it delivered 46.6 million ounces, consuming roughly 50% of available registered inventory in a single month. That alone should have triggered alarm bells across the industry. Then January 2026, supposedly a minor month, saw deliveries between 40 and 49 million ounces, depending on which settlement period you examine. Why would traders demand physical metal in January when they could simply wait 3 weeks for March, the next major delivery month? Because sophisticated players recognized what was coming and decided to front-run the March squeeze. They wanted their metal before the real crisis hit, before delivery queues backed up, before registered inventory dropped to levels that might force Comex into emergency measures. Those January demands drained 40 million ounces from registered stocks, metal that's now gone and cannot be used to satisfy March deliveries. Current registered inventory, according to the most recent CME warehouse reports, stands at approximately 103 to 113 million ounces. Meanwhile, open interest in the March 2026 contract exceeds 100,000 contracts, representing a notional value of 500 to 528 million ounces of silver. Now let's do the conservative math that keeps risk managers at major banks awake at night. Historically, delivery rates on Comex silver contracts run between 5 and 10% of open interest in major months. Most futures traders are speculators or hedgers who close positions for cash rather than taking physical metal. But what happens when word spreads about physical shortages, when Shanghai premiums stay at 45% for weeks, when lease rates remain elevated at 8%? What happens when industrial users and sovereign wealth funds decide paper promises aren't good enough anymore? If just 15% of March open interest demands delivery, a remarkably conservative estimate given January's unprecedented activity, that represents 75 to 90 million ounces requested against current registered inventory of approximately 110 million ounces, with 40 million already delivered in January. The coverage math breaks down completely. Even if Comex could somehow convert eligible inventory to registered status, they're facing delivery demands that could exceed available physical supply by tens of millions of ounces. But here's what makes the situation even more impossible for banks. They can't just decide to convert eligible silver to registered and flood the market to ease delivery pressure. That eligible silver belongs to someone: ETF shareholders, private vault clients, sovereign accounts. Convincing those holders to sell requires offering prices attractive enough to overcome their reasons for holding physical metal in the first place. If physical silver in Shanghai trades at $100 to $130, and Dubai shows 18% premiums and Mumbai adds 25% markups, why would eligible holders sell to Comex at $82? This creates what market analysts call a physical premium spiral. Banks need metal to satisfy deliveries, but metal only becomes available at prices far above Comex spot, so they either pay up or default on delivery obligations. If they pay up, say buying physical at $110 to deliver against contracts written at $82, they lock in $28 per ounce losses. If they default, they destroy Comex credibility and face legal consequences that could run into billions. Either choice represents catastrophic outcomes. Now let's calculate the exact losses banks face at current price levels, because the numbers reveal why $82 isn't just uncomfortable for these institutions, it's potentially catastrophic. The CFTC Bank Participation Report from December 2nd, 2025 showed commercial banks holding net short positions totaling 212 million ounces of silver. These aren't small proprietary trading desks gambling with house money. These are positions representing commitments to deliver physical metal to counterparties who expect actual silver bars. At $82 per ounce versus the $40 target that TD Securities and others publicly forecast, banks face losses of $42 per ounce across those 212 million ounces. Multiply that out, and you get approximately $8.9 billion in current unrealized losses sitting on bank balance sheets right now. That's not worst-case scenario, that's current reality at today's prices. JP Morgan, based on proprietary analysis from researchers tracking their Comex delivery patterns and lease arrangements, likely holds short exposure somewhere between 50 and 100 million ounces. At $82, that translates to losses ranging from $2.1 billion to $4.2 billion for a single institution. When silver briefly touched $121 on January 29th, JP Morgan's exposure expanded to potential losses between $4 billion and $8 billion in a matter of hours. Here's the trap mechanic that makes escape impossible at current price levels. Every single dollar that silver rises from $82 generates an additional $212 million in losses across the banking sector as combined short positions. If silver rallies to $90, add $1.7 billion in losses. If it hits $100, add another $2.1 billion. The exposure compounds geometrically as price rises accelerate. Meanwhile, banks face crushing carrying costs to maintain these short positions. The 18% margin requirements that CME imposed during the January crash remain in effect, meaning banks must post enormous collateral to hold their shorts. At current position sizes, this represents millions of dollars weekly in interest costs and opportunity cost from capital tied up as margin rather than deployed in profitable trades. Think about the strategic options available to banks from this position, because each path leads to destruction. Option 1, cover the shorts by buying back contracts. Except purchasing 212 million ounces on Comex would spike prices dramatically higher as your buying pressure overwhelms available sellers. Analysts estimate that aggressive short covering at current open interest levels could drive silver to $150 or higher, turning $8.9 billion in losses into $23 billion or more. Option 2, deliver physical metal to satisfy contracts. Except physical silver costs $100 to $130. To source in real markets while your contracts obligate you to deliver at $82 or lower, depending on your entry price. Every ounce delivered locks in $40 to $70 in losses, and you need tens of millions of ounces. The math doesn't work. Option 3, hold the positions and hope for another crash like January 31st. Except Shanghai proved that physical markets have established a floor around $100, regardless of what paper trading shows. You can crash Comex to $78, but if physical buyers in China immediately step in at $100, the paper price becomes irrelevant for anyone who actually needs metal. Option 4, negotiate cash settlements with contract holders, essentially paying them money instead of delivering physical silver. This admission that paper doesn't equal physical would destroy Comex credibility permanently, triggering a rush to demand delivery on gold contracts, copper contracts, every commodity market that operates on similar fractional reserve mechanics. Every escape route is blocked. At $82, banks cannot cover, cannot deliver, cannot hold, and cannot settle without triggering systemic consequences that dwarf their current losses. So where do prices go from here? Let me give you specific targets based on current market mechanics and historical precedents. Immediate term, the next 2 to 3 weeks leading into March 1st position day, Expect silver to test $90 to $100 as industrial buyers and informed speculators position ahead of the delivery squeeze. Banks attempting to cover even small portions of their shorts will provide buying pressure, while Shanghai premiums create a psychological floor that prevents significant downside. If March delivery demands exceed Comex's ability to satisfy them, we're looking at potential emergency measures that could spike prices to $120 to $150. The precedent here is the 2022 London Metal Exchange nickel squeeze, when prices briefly hit $100,000 per ton before the exchange took the unprecedented step of canceling trades and suspending the market. That decision destroyed LME credibility for nickel trading and resulted in lawsuits that continue today. Silver markets are 10 times larger than nickel, with far more industrial dependencies and sovereign interest. A Comex default or trade cancellation would fracture the global commodity pricing system. Looking at fundamental ratios, the historical gold to silver ratio averaged around 80 to 1 over the past decade. With gold currently trading around $4,000 per ounce, that ratio suggests silver should trade around $50. But that ratio was established during periods when paper markets functioned normally and physical supply met demand. In shortage conditions, the ratio compresses dramatically. If gold reaches $5,000, as many analysts project for 2026, and the ratio compresses to 40 to 1, silver would trade at $125. More extreme scenarios exist. Former Congressman Ron Paul has discussed $20,000 gold in the event of currency crisis and Fed policy failure. If that materialized with even a 60 to 1 ratio, silver would exceed $300. I'm not saying that's the base case, but I am saying the range of possible outcomes has expanded far beyond what traditional models predict, because we are in a physical shortage situation that historical data does not adequately capture. What should concern everyone is not just the silver market itself, it's the cascade effect that a Comex failure would trigger. Gold faces similar inventory stress, with coverage ratios approaching critical levels. Credit derivatives tied to commodity collateral could destabilize if suddenly the collateral is worth far more than contract prices reflect. Multiple banks facing simultaneous margin calls on precious metals, positions could trigger liquidity crunches reminiscent of 2008 but focused in commodity markets. The Federal Reserve would face a nightmare scenario: intervene to bail out banks from bad commodity bets and face political backlash, or let markets clear naturally and watch Shanghai become the global physical price benchmark, ending 150 years of Western control over precious metals pricing. Either outcome represents a fundamental shift in how commodity markets operate and who controls price discovery. Banks bet $40 throughout 2025, building massive short positions at $50 to $60, absolutely certain that silver would collapse as interest rates stayed elevated and industrial demand weakened. Instead, silver hit $121, briefly crashed to $78, and now trades at $82 with physical markets in Shanghai demanding $100 to $130 for actual metal. They're trapped 105% above their original target, with $8.9 billion in current losses, March delivery obligations approaching in 19 days, and absolutely no escape route that doesn't result in catastrophic outcomes. The Monday reset isn't coming, it's already here. The trap has snapped shut, and the banks that promised to deliver metal they never had are about to discover that the paper market they controlled for decades cannot survive contact with physical reality. March 2026 will prove whether Comex is a legitimate commodity exchange or a fiction that collapses the moment someone actually demands delivery,